Well, g'day there everybody. Thanks for joining me on this Monday afternoon market recap. I'm going to walk through some analysis that we spoke about over the weekend, which led us to believe that although we may be very close to a bottom, we may not actually see that definitive push to the upside play out for a number of days. Today, collectively across the board for the US markets, it was, relatively speaking, a bearish session, although we did push off from the intra-session lows. The Dow Jones Industrial Average, it still closed down just shy of 350 points. Again, we're coming back down to retest that 25,000 area that we've already retested on two other occasions. This is the really simple sort of explanation for this. And again, we went into this in great detail over the weekend, is simply that these oscillators are sort of somewhat mixed when it comes to our outlook, or at least our forecast for price action. You can see this is the chart of the Dow Jones Industrial Average on a daily time frame. This is today's candlestick. And although we can acknowledge once again that we are at a critical area of support and we do expect the support area to hold, we still have to allow these oscillators to push on back down into oversold territory and then to give us the definitive buy signals down towards these oversold levels prior to what is most likely going to be that legitimate and also sustainable move higher. Over the weekend, we put in some contingency orders. However, we were, if we were blessed, wanting to see this market pull on back down. That's exactly what is happening as at Monday, but you can see 25,567 on my screen for the Dow Jones Industrial Average. On the S&P 500, 2757.1. These are all contingency orders to actually jump into either the diamonds or the SPYs. If I bring up the Nasdaq, you can see here 7,340. That will be the contingency based on price to jump into the Qs. Obviously, at the moment, none of these have triggered, which is a good thing because it's giving us, once again, a plan B, or at least a secondary option to jump into this market at a better price. And what it's going to do, it's going to open up the risk and reward ratio. Okay, I'm just going to write R and R on my screen, which is going to make these sort of seasonal trades even more appealing once we see the definitive bottom. Now, at the moment, or as at the close on Monday, there is no bottom whatsoever. At least we haven't seen really all that much confirmation, all right, of a true reversal, other than a little sort of rally towards the back end of today's session. So until these oscillators correct, and what I mean correct is move into oversold and then begin to cross, given of course the technical backdrop that we have been working with when it comes to chart patterns and also support and resistance and candlesticks, that is going to identify to us or signal to us, well, this is the time to actually jump into the market. Otherwise, just allow this market to continue falling if it chooses to do so. Don't be or don't find yourself needing or feeling, all right, that you need to jump in and just start beginning to position yourself bullish. We've gone through a lot of these individual trades in the past, and we have come to the conclusion. You can see on my screen at the moment that we've got green rectangular boxes upon which we expect price to fall into. Now, this is underway at the moment. Boeing Airlines in particular, back down at $320 per share. So a lot of these stocks are coming back into macro support. We haven't actually triggered into any stocks at the moment, but really what we're doing is setting the trap, all right, for when the market does turn. And these lower prices are going to be welcomed. For instance, we've got Caterpillar still looking to come down to $118. COP back down at that critical handle, or just off that critical handle of 64 that we've been speaking about. CVX is holding up better than other stocks. This is another important stock. Google, we spoke about this in great detail, looking at it to come all the way down potentially to $1,000 per share, but we're going to bring down that bullish entry. Over the weekend, we couldn't really do that. Why? Because we didn't have the structure, nor did we have the candlestick indicating the break to the downside. The same is true with Amazon. Amazon today came down very close to 1,500, and now this has just opened up the risk and reward all the way back up to roughly $2,000 per share. It's about $500 of reward, but only when we see that definitive bottom. At the moment, we haven't actually seen that turn, but these stocks in unison and the markets alike are coming back down into their respective support areas, which is very, very powerful. Now, continuing the theme, all right, what I've done, I've gone through the Dow Jones Industrial Average on the daily time frame through the eyes of the oscillators. Pay attention to the S&P 500. Another bearish candlestick today, down, just over 40 points. We're starting to technically register sell signals. That's fine. You don't need to sell short against what is considered to be the primary upward trend of the market. We have expected this market to pull on back down and largely just move sideways as these oscillators move back into or towards oversold, or at least below that neutral 50-point line. And that is exactly what is happening. So again, don't feel compelled to open market positions at the moment. Allow this market to run its course. But once we see these oscillators bottom on the S&P, on the Dow Jones Industrial Average. That is going to be the turning signal, right? And we'll be looking for confirmation to then actively jump into a bunch of stocks. The final market here is the Nasdaq. You can see again pushing back down below that neutral 50-point. RSI is already moving towards oversold, and the MACD is just given us a bearish cross. The good news though is that we should develop divergence, all right, because I'm not expecting this sell wave just here, or at least this sell signal, to take out this little crossover here, which really set up at the very beginning of this particular month. Now, what we've also done, again, I'm not going to go into as much detail. The detail is in the weekend class, which is up online. But if you go into the ADX as well, very important sort of combination that we can use, but only when it's really the right time to do so, is that we needed to see, of course, the ADX to reset. And what I mean by that is generally when you see bullish moves or bearish moves, trends really that are in effect and that are sustainable and are going to continue for, you know, at least longer than 1 month, you really need to see this ADX come back down and sit on the reset zone, right, prior to it turning up. Now, although we got with this bearish candlestick, the ADX somewhat turning up on the S&P 500. It didn't really turn up as much on the Dow Jones Industrial Average. You can see again on the Nasdaq it did. But really what we need to see is to see this ADX, you know, if it chooses to turn up, if we pull on back down a little bit lower, but then ultimately fizzle, head back down towards this resting line as price bottoms. And then when we start to see the white candlesticks, right, or the bullish candlestick set up, the ADX will then pop, and that will signal, right, the beginning of the bullish move, right, that legitimate move higher. So think about it like this. We're using the oscillators, okay, I'll just write OSC, in combination, right, with the ADX, and of course, support and resistance, chart patterns, and candlestick patterns. So there might be 4 or 5 little concepts there that we're bringing together, which is going to give us a really good indication of when the market is turning. We're speaking about the market turning in the future. Is it ready to turn bullish yet? It doesn't appear so. Are we in the market long? No, we're not. Are we in individual trades long? No, we're not. We're stalking the trades, and as such, we're going to bring down the bullish triggers, right, over the coming days, all right, and probably over the next week or so, which is going to lock in, right, the magical reward risk ratio, which on average, I believe, if we sort of discount or at least think about all of the markets and the stock setups that we had a look at over the weekend, it's probably bordering on at least a 7, if not an 8 to 1. Some of those stocks we looked at were above a 10 to 1 reward risk ratio, which is phenomenal, absolutely phenomenal. But you cannot rush this type of situation. You have to let it form, let it come to you, and then when the time is right, we'll jump on into a bunch of these trades. At the moment, though, it's very exciting because the lower price action goes, the better risk reward we are ultimately going to be gifted. And that is a very powerful sort of outlook to hold on to if you find yourself, again, just being patient and waiting for the right opportunity to enter the market. Another secondary market I wanted to speak about very, very quickly, it wasn't the transportational average, it was more so the Russell 2000. Very important market. It was looking as though, if I can bring up the right template, we were potentially beginning to crack the 2018 lows, but we still haven't done that. And if I go out into the monthly chart again, this is going all the way back to the beginning of the bull market in 2009. These are your 4 decelerating fan lines. At the moment, we're sitting right on this 3rd decelerating fan line right here. So although we did see the hold, the bounce, we're coming back down. We're trading about 1,500 on this market at the same time, again, allowing these oscillators to reset. If we push down below, that's okay. As long as we don't crack below the October 18 lows, this market ultimately should hold and then turn as well. So I'm looking at the Russell as potentially a little bit of a leading indicator, or at least to show us that there is a little bit of a bid underpinning some of these lesser known or at least smaller companies out there on the US financial markets. That's one very important market. And then the secondary market that I will navigate to now that I just brought it up earlier was the transportational average. It looks to me at the moment that we are technically back testing this decelerating fan line, but at the same time, it appears as though we've overshot support and we've seen a very strong rebound rally, which has really just pushed us back into the middle of what appears to be an accumulation. I am seeing a lot of talk out there around the place when it comes to, let's just break it down, accumulation, distribution, or public participation. A lot of people are naturally calling this a distribution. And look, I tend to disagree with that. In my opinion, this is just going to be a 2018 type of consolidating year or consolidational year. And what's going to happen is ultimately, once we do see the turn and once we break above the swing high, people are going to look at this and then they're going to begin saying, well, look, this was just an accumulation for people to position themselves into the move which is upcoming in the year 2019, which would be to the upside. So that's the way I'm looking at this until we see definitive close, right, below roughly 23.5 or at least 23,000 on the Dow Jones Industrial Average. This is all very constructive. It's all very healthy. And again, think about the oscillators in combination with the ADX, in combination with support and resistance, in combination with C for chart patterns and also C for candlesticks. All right, and they're going to be your best friends at this particular time. That's what's going to help you out the most when it comes to the turn in the market. All right, the turn in the market. So if you have any questions, email me. Otherwise, jump into that pro analysis class if you want to find out more about the technical analysis. Other than that, everyone, later this week, it is, of course, Thanksgiving holiday. So it is going to be a shortened week of trade. My apologies for that. Okay, I thought it was going to be a full week. Last week when I was talking about the markets looking forward, made a little error there. We've got the public holiday this week, so it is going to be a 4-session week. All right, all the best, everyone. Enjoy your Monday evening. I'll be back with you later in the week for another market update. All the best. Farewell.